Hey everyone, this is Steve Elwell, Chief Investment Officer from Level Financial Advisors. We thought we'd put out a quick video on some market commentary, given all the things that are happening in the investment markets, the stock market, the bond market, the Federal Reserve, all this stuff going on. So we thought we'd give some perspective on what's happening, what's causing this, and what should investors be thinking about. So the big picture is the dominating headline, everything that everybody's talking about is inflation. Inflation. The Federal Reserve's worried about it. All of us in our day-to-day lives are worried about it. We see it at the gas pump, we see it at the grocery store, we see it in the housing market, we see it everywhere. So when it comes to inflation, the Federal Reserve's main tool to fight that is raising interest rates. They had held off on doing that for a pretty long time after we sort of crept our way out of the COVID shutdowns economically. And the most recent report that had come out in May had shown that inflation had increased by 8.6% annualized for the month of May, which is way beyond the 2% target that generally they're looking for. So that causes a lot of problems. Obviously, it's more expensive to buy things that all of us want to buy. And inflation also is a bit of a psychological problem in that if you think next week's prices or next month's prices are going to be substantially higher than this month's prices, then you're going to try and buy things faster. And that makes the problem worse. So the Federal Reserve knows this. They know it's bad for the economy in general. They know it's bad for people in general. And so that's one of the dual mandates that they have, is to keep inflation in check. The other mandate is to keep unemployment low. And they've already solved that one. I mean, they didn't solve it on their own, but the job market looks fantastic. In fact, there are 2 times as many job openings as there are people that are looking for jobs. So if you're looking for jobs, things are great. If you're trying to hire somebody, it's pretty hard right now. So because that already looks good from their perspective, they have fully turned their attention to tackling the inflation problem at this point. So what have they done so far? In March, they raised interest rates 0.25%, which is the traditional increase that they would do as they start to tackle inflation. They do 0.25% sort of at each meeting, and they have several meetings a year. So then again in May, they raised interest rates, but this time they raised them 0.5%. So they were a little more aggressive. And then just yesterday, they had a meeting for June, and they raised interest rates by 0.75%, which is the largest one-time increase in 28 years, since 1994. So a big deal. They have effectively taken off the gloves and are punching back at inflation to try and tamp this down, to bring this down. Now that creates some moving pieces here, right? So number one, inflation and rising interest rates is bad for bonds in general, particularly long-term bonds. And so that has really roiled the bond market this year. The bond market is off to a historically bad start. I'll give a little context here to get to the bottom line. We generally lean towards shorter-term bonds, which are less affected by interest rates going up and less affected by inflation, generally because short-term bonds mature quickly. You get your money back, you can reinvest at these new higher interest rates. So the bond market, what's happening there in general is pretty dramatic, but actually for us is quite a bit less dramatic, which is good and by design, because of course we're working with a lot of retirees, as you guys know, and we want to make sure we always have a place to get money that has not gone down dramatically in value, no matter what's happening in the stock markets. So that's kind of a big picture reason of what's actually happening right now is inflation is high. The Federal Reserve is really aggressively starting to tackle that by raising interest rates by a lot so far. Now the stock market has reacted to that as well. And the stock market's concern, of course, is if interest rates go up dramatically, and 1.5% cumulatively in the last 4 months is a pretty significant move. If interest rates are going to go up dramatically, what effect is that going to have on the economy? Are people going to spend less because things cost more? A car loan costs more. To get a mortgage now costs more because the interest rate is higher. Credit card interest rates are higher. Home equity line of credits are higher. All of these things might mean that people spend less. And if they spend less, we might go into a recession. How deep of a recession might that be is anybody's guess. That's what we're all about to find out in the next few months. If we even go into a recession, there's no guarantee that that will even happen. Because again, the US consumer at the moment is in actually pretty good financial shape when you look at the amount of money that people have in savings, the amount of debt they have relative to what they have had historically. And then on top of that, we already mentioned the job market, which looked really good. And we still have a lot of demand coming out of COVID with people that haven't traveled for a couple of years and now want to, and go back to somewhat of a more normal economic scenario where they're doing things that maybe for the last couple of years they hadn't been doing. So the stock market, though, being a forward-looking machine, is trying to figure out what is happening in real time. And so as these interest rates have gone up quickly, the stock market has made its short-term prediction by going down approximately 20% in the S&P 500 this year. The prediction being that, yes, there is going to be an economic slowdown. There is going to be potentially a negative effect on corporate profits, and the stock market is reflecting that. Now, the old joke about the stock market is, in the short term, it's a voting machine. Everybody gets their vote. Everybody puts in what they think is happening, their input. In the long run, the stock market is a weighing machine in that the truth comes out. So if stock prices go down too much and the stock market overreacted and it turns out corporate profits are just fine, then you'll likely see the stock market recover. Or not even if it's just fine, if it's just better than expected. And that's always the measuring stick, is not whether corporate profits were good or bad per se, but were they better than expected or worse than expected? So that's a big piece of what's happening with the stock market, and we will find out here over the next 3 to 6 months what effect really did these interest rate increases have, number one, on inflation, of course, but number two, what impact did they have on the actual economy and actual corporate profits. But it is important to note that while the S&P 500 might be down around 20% for the year, other stock categories actually are not. So for instance, small stocks are doing better, value stocks are doing better than that, international stocks at this moment are doing better than that, emerging market stocks are doing better than that. The vast majority actually of other stock categories has lost less this year than the S&P 500, which goes back to this big picture idea that, of course, diversification always makes sense. It's the best protection you have as an investor when you're taking risk, is to spread your money around. And of course, we have done that. So Federal Reserve's raising interest rates. Stock market is a little upset by that. Bond market is upset by that. We'll see what happens with the economy as to whether we end up going in a recession or not. But the big picture is that's sort of what's all happening here from a cause standpoint, is if you're looking for a couple of reasons as to what is even causing all of this volatility, that's the story. And most of you probably already know that because it's planted on the news everywhere and you're seeing it in real life. So that's one piece. The second piece is the context of, well, what does this actually mean for me? What does it mean for my portfolio? Does it mean I should change something? Should I make an adjustment? Should I spend less? Should I sell out? What should we do in this scenario? And the first thing that I think I would point out is, even though this has been a pretty volatile year, for the vast majority of our clients, the advice would be there's not really any change that probably is needed from an investment standpoint. And there's a really big reason for that. We tend to build our portfolios in a way where, as I mentioned earlier, we always have money in a safer portion of shorter term bonds that we can lean on whenever the stock market or other investment categories struggle. And that's by design, that's on purpose, because we know if you're investing for 30 years like the average retiree might, it's not a question of if stuff like this is going to happen. If there's going to be a stock market decline over that period. Not only will there be a stock market decline at some point over a 30-year period, there's probably going to be 10 of them, give or take. So we know you're going to have to deal with this. The causes will always be different. You know, the financial recession from the 2008 crash, COVID, European bond crisis, you know, war in Ukraine, inflation running rampant. I mean, whatever the reason ends up being, we know there are going to be times where the stock market goes down. So we need to be prepared for where are we going to get money from when that happens. So we are well prepared to outstand or outlast several years of protracted downturn if that's what's happening or what ends up happening, which we are not certainly predicting that. But even if it did, we would be prepared in that scenario already without making any adjustments for the vast majority of our clients' portfolios. So that context is important. The next piece of information that I think is worth pointing out is that our friends at DFA had actually done some really good research that had said when there's a 10% stock market decline, the average one-year return for the year after that is 12.5%, which is slightly higher than the historical average one-year return for the stock market. When there's a 20% decline in the stock market, which is where we are today, literally right now, the timing of filming this video, the average one-year return for the next 12 months is 22.2%. And for a 30% decline, the average one-year return is 23.8%. Now, those are averages, right? So that doesn't mean that's what's going to happen this time. It could be more, it could be less, it could still be negative for the next 12 months. But I think it's important to give that context of what tends to happen after these declines, typically after these declines happen. If you go out to a longer time frame, the cumulative returns for the next 3 years or for the next 5 years, the numbers get even bigger than that. So we got a nice graphic here that we're gonna put up that we just showed that will reflect all of that information. So we think that's really important. And the next thing that I would want to point out is just simply from an investment standpoint, what alternative might you have if all of this is at the moment making you uncomfortable? And the first part is, of course, to talk to your advisor about how does my plan look relative to what's happening, which, as I said, for most of you, we have money in safe spots that can last us years to withstand this. But beyond that, your choices from an investment standpoint to make changes, your best option by far will be continue to stick with the game plan. And the reason for that is the alternative is to make some adjustment that tries to, often what we hear is try to reduce any further declines that might happen. Which of course inevitably also means if a recovery starts to happen, you would not participate to the same degree you would have if you stuck with it. So you may miss out on any recovery if you reduce risk now because you don't want to face potentially any more declines. That's a big risk. In my 16-year career, I have not seen anyone who has been able to correctly time the market in that sell, have prices actually go down like they thought they might continue to, and then buy back in at a lower price before the market recovers. I have never seen it. It doesn't mean it can't happen, but you have to actually be right twice if you think about it. You have to sell before the market continues to go down, and then you also have to buy back in before the market recovers. And often people say something a little more generic like, I want to get out now and I'll get back in when I feel better or things look better. Well, the reality is things move too fast for that. When things look better or feel better, the stock market will have already started to recover. And the most likely thing that will happen is if you sell or reduce your stock holdings to try and prevent further declines, the most likely thing to happen is by the time you're ready to get back in, prices will already be higher than what you sold at. And the end result will be you actually cost yourself money, as opposed to just simply sticking with the plan, knowing that we already had money set aside in safe places if you needed it, and we didn't need to touch any portion of the stock part of the portfolio. So the alternative of sticking with the game plan is not attractive. The chances are not in your favor at all to be able to time the market. No one consistently has been able to do that, even the world's best investors. So I think that part is important. And what things are worth checking out when you see a stock market decline like this, the most obvious is if you have any tax losses that we could take to write off. We should take those. A lot of you probably are thinking in your head, I've already seen that, because we've done a ton of that already this year, and that will help reduce your tax bill this year for those that have non-retirement accounts. So that's a silver lining of a stock market decline. On top of that, either depositing excess cash if you're someone who's still saving or who happens to have cash that you were thinking about investing, you're now getting a 20% discount on stuff that you maybe were already thinking about buying, which is obviously generally a good thing. Rebalancing is the same idea. If we take some money from the portion of the portfolio that might be overweight, like short-term bonds, and we use that to go buy stocks while they're on sale, when the inevitable recovery happens, that would result in a faster recovery for you because you'd taken advantage of these lower prices. We did that with great success in March of 2020, April, May of 2020, during the COVID downturn that had happened. And then a little more complicated, but beyond that, from a tax planning standpoint, a lot of you, we help do Roth conversions each year, and a stock market decline helps accelerate the value of Roth conversions in the long run, because you're able to convert more shares because the price is lower, and then when the recovery happens in the stock market, all of that recovery after conversion takes place inside of a Roth IRA. And so it really helps maximize the value of doing that. So there are some things that can be done to take advantage of the scenario of what's happening, some silver linings, but from an investment standpoint, we don't think there's any reason to make huge changes to client portfolios, knowing we've already designed the portfolios to withstand years of this type of volatility, and we're only 5 months in on this so far. So as we get more information from the inflation reports and what the Federal Reserve is doing, and the economic reports and the corporate profit reports for all these public companies, we're going to see how this ends up affecting everything. But ultimately, in the moment, we wanted to go through the context of what's happening, what options people have, and why some of them may not really be that attractive, and some of the silver linings that exist in the moment. So as always, if you have any questions about your particular scenario, your portfolio, your game plan, reach out to us. We're obviously happy to talk through everything that's going on and to help make sure that everything is going to be working perfectly and smoothly for your retirement plan, your financial game plan. So reach out to us if you want to talk, and until next time, we'll talk to you soon.